Okay, good afternoon here on October 27th. So I am filling in for Wayne for this video for the weekend. Uh, Most of you guys know who I am. My name is Ryan Mastro, and we are going to do a little macro measure here. Probably a little bit different than you used to because Wayne does such a phenomenal job with this video, but I just had to step in and fill in. He had an emergency he had to handle. So again, let's get into our quick disclaimers here and we can get started. Okay, we're going to move over to our Thinkorswim here real quick. And let me just close a couple things down. So on my Thinkorswim, we're going to get right into the charts and talking about what's going on here. So in the Qs, we had a really good run up on Friday, but unfortunately gave a lot of that back. We still had didn't fall back into the gap there. So definitely a great look for what has the potential for a very good week. We'll get into the earnings this week and some of the stocks that we're going to be looking at for this week on that. But you can see this really big yellow downtrend line here, or I should say uptrend line, I apologize, where we did come down and touch that on this big down day on Wednesday. And then between Thursday and Friday, just awesome rallying. So again, taking out the high right here, critical. I love to see it close up there. But was not able to get up there and stay up there on Friday. So big level back over in here after we get through here. So that will be in the potential that we have some good earnings reports out of our big names this week. So we'll talk about them in a second. We might be able to get a nice little pop out of the Qs here. Now, failure. Again, you could be as aggressive as you want in terms of drawing trend lines. You could be drawing it up through the lows right in here. If you really want to be aggressive, I'd probably use something like Friday's low, all right, maybe comes back down and fill the gap depending on what happens with earnings. Tuesday, Wednesday, and Thursday are going to be the big weighted names. So we'll be really kind of focusing on those in terms of the bigger picture. But Qs need to get that solid close. This high right here is 498.83. That's a kind of level right there. I believe that kind of marries up with that yellow line is that top. So we really want to see that close above there. If we go across the board, we didn't have quite as much love on or I should say in the diamonds on Friday. So again, coming down to that downtrend line, and we've had a lot of names that have gotten hit pretty hard here. So Friday was pretty ugly, and I don't know if I can give you the visualize on that. Let me see if I can do it this way. Index watch, and I think I can do it this way. I'm not sure if it's going to give me the day though that I need. So it's going to give me, oh, it does. Okay, perfect. So in there you can see what really got hit. McDonald's really got routed after its sell-off and then rally last week. Travelers Group was down pretty strong. You look over here, Dow Chemical, Goldman Sachs, IBM, J&J are some of the bigger ones that were down below 1.25%. You had one or two big ones, Intel up very, very small, but again, for the stock, not too bad in terms of that. Salesforce was up. So you can see what 6, 7 stocks that were actually green on the day. Everything else was red. So that usually is a sign that they are just blatantly coming through and selling the diamonds overall. And then the weights basically following through on that. So only a handful of stocks that were bucking the trend on that one. So when we look at let's go back to our quotes over here and back to our charts. In terms of the diamonds, that was pretty ugly. And now breaking down below a downtrend could get even more ugly. So I'd be probably looking at a bigger area right here, which you see the 50-day and the support back in here. That swing low is 418.28. So we do drop down below that. This could start a bigger round of selling in the stocks in the diamonds there. So got to be careful. Now, IWM looked pretty much the same. Long-term downtrend right in here. This goes way back, right? And just been we had two kind of breaks down below here, but picking up. We touched it on Wednesday morning, but been pretty ugly since. So again, I think that's one that you're going to have to wait a little bit, maybe use Friday's high, right? Feel like maybe we can get back above there. Maybe we can get a retest of these upper levels, like 225-ish. But I think it's going to take a little bit of work for that one. Last but certainly not least is the spiders. And again, looking at that yellow line there is that longer term regression of the middle of that. This one in here is just the bottom, similar to what we've been drawing on all these. Didn't quite test it on Wednesday, rallied up, but really didn't get that solid close that you'd want to see. Feel pretty good about this, where it would kind of reverse this candle, where we had a green candle closing back on the upper end of this range. It was just red. So just like the diamonds had the gap up and sell off, this was a little bigger of a sell off, actually closed below Thursday's close, but still made a higher low. So that's definitely a good sign. But again, little bit still red in terms of the weakness. So I think going into this week, it's going to be one to watch on that. Now, in terms of overlays on this chart, I do want to do a couple quick overlays to show you the deterioration of what we saw this past week. This is your 50-day. This purple line is your 50-day in terms of your breadth indicator. So the amount of stocks in the S&P 500 that are breaking down below the 50-day. And I'm always trying to look at where these things are, and what, let me see if I can just kind of draw. I'm trying to draw a purple line in for you so you can see these a little bit better. But you can see when the market has been doing very well, that you just use that kind of that yellow line right in there that is showing you that it's been doing pretty well in terms of trend. Well, you look at the tops, right? Even the top of that, maybe tightening a little bit, making this more of an ascending wedge. We have seen the increase here where we have these spikes, right, where we have increased. So that's a good sign that they're getting back above the 50-day. But now in the recent couple of weeks, we've deteriorated to the downside. So while you look at that uptrend on the yellow line, right, this thing kind of keeps going up, we're deteriorating in terms of the amount of stocks that are actually falling below the 50-day. So this, to me, especially this area right in here, let me see if I can just kind of draw this, right? This area in here down below kind of this flat line rare definitely is a little bit concerning. Now, bigger trend on the downside, right? Let me just get rid of that. All right, I'll get rid of those two. Go back to drawing this. All right, I would say, you have still a pretty good trend on the downside to be able to hold. But again, what we want to see is this actually start to go back up, right? In terms of moving back up in that direction. Now, if we clear all that out and show you on the charts the amount of stocks over their 100-day, right, you can see we've seen that same deterioration, definitely taking out a level where we are getting pretty critical. Again, not as clear of a kind of an uptrend in here. Maybe you want to use the highs in here. So I would definitely be cautious now that we're making a new low versus this kind of spot right in there on that recent swing low. If we start to take out maybe this one over in here, this could start a much bigger rollover on the market. And then we want to look at real quick the 200-day. And again, I would probably use this as your best gauge, right? This is kind of the more of the longer term moving averages on the 200-day. So it gives you a better feel. And you can see we've topped out on this one where this is kind of really not doing much, maybe a slight uptick in this peak right in here. We didn't, even with the market going higher in this area, we failed to reach a higher high. It was kind of right about there in terms of that purple line. So this actually is deteriorating, and now we're actually deteriorating here. So that's definitely something you want to be aware of, is the amount of stocks that are going above above or below that big moving average. So that's definitely a great indication of kind of the overall health of the market. So a couple other things that I want to compare this to. If we come back in here and look at your weighted, or your equal weight, I should say, in terms of how this market has been moving. And again, you can draw kind of where your purple line is, and this is still on that purple line is your 200-day amount of stocks above their 200-day. So, kind of flat line up in there. You can see all those tops. They've moved pretty much in sync, right? Where this has all been doing pretty good. I put that on a line versus that. So, those bottoms, let's just say kind of like that, been looking pretty good, but we've been sitting here flatlining on the top. Are we going to get a purple breakout back to the upside? Well, we've already kind of broken out on the on our market. So if I were to draw that market kind of move, this is your RSP, right? We've been kind of moving higher, and on basically every time we have a spike, we made a higher high here on the RSP versus the breadth, and you have another one here, another one here. So these continue to move higher, whereas the market really is not in terms of really reading and how many stocks are actually improving here. So that is a little bit more of a deterioration than I would like to see. And maybe the RSP, which is your equal weight, actually starts to show you something more towards the downside. So that would be something I would keep on my radar, maybe deteriorating, taking out a low. Maybe you want to use something like this or the 50-day on this one specifically. Maybe you do start to play that to the downside, as it could be very, very interesting. And I want to try one thing here. And okay, let me just do this over here. So I want to come back over to our calendar, and I want to talk quickly why this week is critical. So we have several reasons here in terms of what's going on. Not only are we I don't know, I'm sure everyone else is counting it down to 8 days or 7 days to election, whatever it is, right? And again, that's going to be a big thing. And there's a lot of talk that several states have said they're not going to be able to count these things, but it's amazing third world countries can do it in a day, and populated states that can't handle it. So again, I'm not getting into the politics of this, but I think what I'm trying to tell you is more around the idea that we're not going to have a clear-cut answer on Tuesday, at least forecasted by, I believe it was Arizona, Michigan, and I think even Georgia basically said they're going to be delayed. So you look at those three and you say, okay, these states are not going to be calculated. Well, they're pretty critical swing states. So we'll have to see, unless one candidate blows out the other in a very dramatic way, which I don't think is going to happen. I think we'll have something that is delayed. So we're not going to see something on Tuesday, may not see something till the week after. And maybe, I think Arizona was calling for 2 weeks. So we'll have to see how this truly plays out in the bigger picture. I think that's going to create a little bit more volatility in terms of the grand scheme of things. Now, add to what the bigger picture is, we have inside of this week a very, very crazy week, right? So we have between our Tuesday, Wednesday, Thursday, we're going to have our Google in here. We're going to have Microsoft and Meta in here. We're going to have Apple and Amazon in here in terms of the big weight. So this is a very, very important week for how the market's going to move forward. Now, it's not the largest amount of stocks, right, in terms of reporting, I think the week after. So going into the first week of November is going to be volatile because of the amount of stocks reporting, along with your election on Tuesday. Again, I don't think we're going to be getting any kind of major news there. Maybe we get a lean out of the market, or I should say out of the reporting, one candidate versus the other. But I think in the end, the big picture will be, when it's finalized, where are we heading in terms of this country? And, is there more, I kind of say, optimism around the business, or maybe pessimism around business? I think that's where a lot of people are treating. I mean, they're talking about different tax schedules. They're talking about, different ways of running the country. So it would be very, very interesting to see what side we are coming out on. And I think the market will give you a very good indication of that. Now, the other piece I really wanted to discuss was where we are in terms of our VIX. And I know Wayne's talked about this. And typically going into major elections, the VIX doesn't really show you too much, but we're steadily holding around this 20 area, and definitely something that I would be concerned with going into a very volatile potential week with earnings and up and down. We could have some reports that come out great, stuff that we've seen in the past, but then the guidance just kind of tails off for it and they can't really give a solid guidance. I think Apple could be one of those, right, where you get maybe a little bit of forecasting could be a bit of the problem, because we've seen some analysts come out and downgrade their numbers. So we'll have to see what Apple comes out and says. Obviously, they are cash rich, and it doesn't really matter in the grand scheme of things. A couple million less iPhones is not the end of the world, but the guidance and then what comes from that guidance in terms of the analysts really could swing that stock. So I would definitely be on guard in Apple. And when you look at Apple, and look at the kind of the ascending action of that one, if you just want to kind of draw that in there, they've been doing a very good job of holding that in this uptrend. So any break of the uptrend, right, this could be, pretty dramatic in terms of the level. Now, I would say when you look at, let me go back over to Market Watch and show you that, because I had talked about this in the cocktail hour in terms of the stocks that are expensive versus others. So if you look at this right in here, now maybe I went down a little too far, but if you look at, let's see, this one, I think I highlighted it properly. So that one right there. So this is actually Netflix. This one here is Amazon. So, and the only reason I'm saying this because I got a thing covering my screen over here. Just trying to move it out of the way. It's not moving properly, but okay. So we have Apple. Apple is one of the cheaper ones. This number here, 56.59, is the where the stock, or where the stock is, the implied volatility of that stock inside of the implied volatility range for the past year. So that's at 56% off the low. This one's at 86, this one's 70, this one's 68, 65. So just to show you that these are, and again, maybe that's booking. We don't really care about booking, but you look at these couple in here, you say 85. Well, again, that is Meta, and that's, again, more on the upper side of that spectrum. We still have a couple days to go, so that could continue to move higher. But let's look at each individual ones of these and show you where and what we're talking about. So I go to Apple at that 56%. What I'm showing you is that when we look at the implied volatility, we're at about halfway in the middle of this zone. So if I were to take a 43 and going back a year, something like 13, so I should be somewhere in the middle. So 13, let's say 43, so it should be somewhere around 30, which we are. And this is the 30-day implied volatility. So we're getting a good gauge here, and it's not too expensive. It's not too cheap, right? And again, I'm not going to say it's just right either, but when you look at it from the bigger picture, right, is a November 1st option, right, worthy of playing if you really think you're going to get a bigger move or potential of bigger moves, right? Do you think it's going to be the upside or downside? You really like the cheapness of the implied volatility. Maybe you do want to buy some options in here and take advantage of something like that. Your straddles only, let's see, we're at 31. So let's just say the 32 level. So you're at 935, which is not too bad, right? Not too bad in terms of the potential. And do you think it can move beyond 935? That's the question, right? And then I would say from a chart perspective, okay, I try to look at the most recent swing high and swing low. We're sitting at 230. I think we could definitely get back up to that 237. I definitely could think we could get back down to the 220. So maybe it's a little bit expensive. And then I think what you want to add on is the potential for if we do get a bigger break, right? So we do have some negative news. Can it drop down below here? Can it make a low back down to maybe 214? So that's really where you would make your money if you were having or buying let's call it buying the implied volatility or buying a straddle or strangle in the stock. You really needed to make that secondary move beyond the closest swing high or swing low. And that's potential. Great news would probably break it out. You can easily get more than that $7 right in there. Or to the downside, I think you could easily get that if it starts to break in a bigger picture. Now, to compare to the other ones, Amazon really wasn't, oops, typed it in wrong, sorry. Amazon really wasn't as cheap, right? And you can see that because we're on kind of this upper end of this range. I think we were about 69 or 70. Let me see. Amazon, we were 71. I apologize. 71.54. So again, that's just saying you're at about 70% off the low. Okay, no big deal. Just showing you in a range of, okay, it's not the cheapest one out there, right? But it's not necessarily the most expensive either. And that's comparing it to itself, nothing else. Just how Amazon's implied volatility is compared to its prior ranges of the past here. So I like this one. I like that it's in this kind of consolidation. in terms of being able to draw lines and saying, okay, I can easily see breakouts in here. You can see the big downtrend that's kind of coming into this as well, right? So this mini kind of consolidation in here has held this in check for, almost 3 weeks now, right? You can, if I drew a box on that, you could easily see the kind of range and kind of where we've been stuck in terms of that consolidation. So we break out of the consolidation. Yes, we can get a little bit bigger of a move. Again, getting a little bit more expensive in terms of the options. This one, trading a 187, you're talking about $13, right? You're talking about 12, yeah, almost 12.95 on that one on the offer. So you want to understand that they're expecting a pretty dramatic move, a little bit more than that Apple at, what would we say, $9-10. So a little bit bigger in terms of the potential here, right? In terms of, because the implied volatility is a little bit higher. If you go down to a Microsoft, and you can see, again, maybe a slightly better looking trend on this one back to the upside, that, again, surprise kind of move this week where we had the big start to the week and they were able to actually hold it with a slightly higher close, not really making any significantly new higher highs, but you do have this trend that is right here, right now, and ready to be broken out. Didn't really get the solid close that we needed to break it out on Friday. So again, going into Wednesday's earnings report could be very, very interesting in terms of this one. We are a little bit more expensive on this one. I believe we're in the 68 range on that. Let me take a quick peek again. Microsoft 70 right on the nose. And then we'll look at Google and Meta in a second. But this is going to be on Wednesday along with Meta. So I think we could get a little bit of that extra volatility. Let's say they both are negative. Maybe you get a little bit more selling, or they're both moving to the upside in a bullish way, then maybe get a little bit more movement to the upside. If they're kind of mixed, one's bull, one's bear, maybe that negates a little bit of the market move here, and negates and kind of holds them somewhat a little bit tighter to being unchanged versus having a bigger move. Now, you could have a dramatic move in both directions. One's really good or one's really bad. I don't think you're going to see that, though. I think they're going to be kind of somewhat in line with each other in terms of how things are playing out. So Microsoft, I still think looks pretty good. And then getting into Meta, again, one of the most expensive ones. This one is, I think, a little bit more expensive because of all the selling we've seen in here, right? You look how many red candles have come in. I would say more towards the downtrend than anything. But, with a downtrend, that comes any positive news out of this thing and guidance makes this thing really easy to pop, right? And get back up through resistance. So you can see when they really want to move this thing, they can really get it going. So I could definitely see a news cycle that allows this thing to really pop. The straddle on this one, clearly a little bit more expensive, right? You are a $570 stock. Your straddle, right? And we know that it is a higher implied volatility. We saw that on the initial kind of market watch grid, 80-some%, 85%. And you can see we have a almost what's that, 46, 40, call it 47 and change, 48. So again, pretty big move expected for Meta on $570 here. So you're talking about all the way back up and taking new highs on that one, or breaking down to, let's see, we're looking at almost 50 down, 40. So somewhere, even right in here is 23. That's your 50-day. You have a big gap to fill down here, 546. So those could be easily reached, right? So maybe the implied volatility is a little bit high on this, but it's definitely warranted given the potential movement of this stock. So I think that's definitely one to be a little bit concerned with in terms of what it could do to the market. Slightly higher implied volatility. And once you get these in terms of their implied volatilities out, that should bring the VIX down a little bit, right? So you get all the weights done and out of the way. We don't have some significant carnage in there. I think that's definitely one where, again, a reason not to buy implied volatility or the VIX, because I think if we get, let's just say we get muted reactions to most of these, then the VIX theoretically should get a little bit of a sell-off here. It could be in the 16, 17 handle, but that doesn't necessarily mean you want to get out of any VIX positions. To me, I will be holding my VIX position through the election, right? And probably holding it until we get some clarification of that election. because if we start to have protests, if we start to have any of those things in here, then that really could play into the market in a much bigger way, whether it's up or down. And that's when you own your options, when you have this potential for a bigger move. So that to me is a very, very good sign in terms of what we're looking at there. So in terms of this week coming forward, I'm definitely going to be keeping an eye on what's going on with our 10-year. We've seen the mortgage rates rise. We've seen credit card debt. I had a couple different reports that I was watching. The credit card debt is rolling over, and it continues to roll over because people are not paying off their credit cards or paying down their credit cards, right? It continues to play out. I'm going to continue to watch the dollar as well. As the dollar chart, you can see that continues to be an absolute beast of a move. And I think when you look at the other one piece that I've been watching is, again, along with the dollar and the yields, is what's going on and with this. I think they call it the small bank kind of liquidity. And what we're seeing is that the Federal Reserves, I think it's the BTFD, basically is supplying and helping out these small banks with some of the liquidity, and that is being drained, right? So that, I think they say in the next couple of weeks will be going to zero, and that is somewhat problematic, right? They haven't announced any plans to replace that. We've also seen a couple upticks in terms of the underlying amount of debt that these small banks have. So we're getting back to that point where interest rates going up, not necessarily helping out these small banks at all, and they have a ton of debt on their balance sheet. So if you do remove this liquidity completely, does that cause a banking problem here in the next couple of weeks? So going into election, going into some potential with the banks, it definitely would be a little bit concerning on the bigger picture there. So I think I'll leave it there. I hope you guys have a fantastic rest of your week. Hope this helped out, get you a little bit more prepared. The levels will be going out here shortly in the market outlook. So once this video is done, I think we'll get this thing posted and get it out to you guys. So again, I hope you guys have a fantastic week. You can ask us anything you want in their respective forums of your services. And I will talk to you guys this week in the webinar. So good luck, and we'll talk to you guys soon.